Hello and welcome to an FX Times daily video recap. I'm your CMS Forex market analyst Nick Nassad. Today is Tuesday, November 17, 2009. As we mentioned in our morning video brief, we saw that the Greenback gained in today's trading as we had several factors, including comments from ECB President Trichet, a dovish RBA meeting minutes report, and some weaker fundamental data from the US, along with falling stocks, all adding to a sense of risk aversion in the currency markets. The euro dollar that we see here tested its lows from the end of last week in early New York morning trading and fell even a little bit below that to the 1.48 area. This level of support is a correction to this rise in favor of the euro from 1.46 to 1.5050, and you see there's around the 50% retracement level. However, we did go a little bit below that, and that support matched up rather nicely with our support from the end of 2 weeks ago, where we had a consolidation zone here with a low around 1.4815, let's say. In afternoon New York trading, we saw US stocks reclaim some of their initial losses, and the euro managed to win back, about 1/3 or 1/4 of its losses for the day. We'll now see if the 1.50 area, which acted as pretty stiff resistance in last week's trading, does so again following yesterday's test here. We could also just be moving down to test support around the 1.48 level before we have another euro rally. Before we look at more market highlights, let's take a look at important fundamental releases from today. In the US, industrial production for the month of October rose 0.1%, which was lower than forecasts and lower than the pace we've seen the past 3 months, where we had a rather strong surge in industrial production. You can see that on our chart to the right, where we had 3 months of rather strong gains in output, and which was followed by this month's pause. Manufacturing output was down about 0.1%, and the gains that we did see came from utilities. However, in a positive sign, we did see capacity utilization, or the number of factories that are currently in use, increase to 70.7%. This extends a streak of gains and is up from the recession low of 68.3% in June. The reason I say this might be just a pause is that new and unfilled orders continue to grow, as we saw from the ISM manufacturing PMI, as well as from the Empire State Manufacturing Index, and businesses yesterday were shown to continue drawing down their excess inventory with business stockpiles. The inventory to sales ratio at 1.32, which is the average it had been for the period of 2003 to 2005. So it seems that businesses have worked off a lot of their excess inventories, and with new orders to fill, manufacturing production should increase again. Moving along, we saw producer prices in the US increase 0.3% on the month in October, and they were down 1.9% in annual terms, which was an improvement compared to the 4.8% decline we saw in September in annual terms. However, if we take a look at the core rates, we see that we had rather weak readings with the core monthly rate down 0.6% and the annual rate at 0.7%, much lower than forecasts and what we had the previous month. So what this means is that wholesale inflation continues to be rather low, and that doesn't add any pressure on the Fed to think about raising interest rates in order to hold down inflation. Also, we see that the primary driver for the increase in producer inflation was food and energy costs, as the core rates were very low. In a third report from the US, we saw that international demand for long-term US financial assets strengthened in September, as we had net buying of long-term equities, notes, and bonds that totaled $40.7 billion, which was higher than expectations. Countries such as Japan, the UK, and China added their holdings of Treasury debt, which showed that international partners are still sending sizable capital flows into the US. Monthly net TIC flows, which include short-term flows, rose by $133.5 billion. So this is an important release showing that the US is able to keep funding its deficits by being able to sell debt, and that there are buyers for that debt. Finally, in the UK, we saw consumer prices as well. They measure theirs mainly in annual terms, and we saw the annual pace rise to 1.5% from 1.1% in September. That was slightly better than expected, and it was the first time we saw this that annual inflation rose in 8 months. We moved up from a 7-year low of 1.1% in September. On the month, prices were up 0.2%, following a flat reading in September. So now the Bank of England predicted that inflation was going to increase in its last interest rate meeting, but though it said that the increase would be due to temporary factors, and that in the medium term, slack in capacity utilization is going to keep inflation rather low, especially like towards the middle of next year. And with the Bank of England, having just expanded its quantitative easing program, it is definitely way too soon for the Monetary Policy Committee to begin thinking about tightening rates in an environment when economic growth is still rapid. Here's our pound-dollar pair with 30-minute candles, and we see following a rather strong rise in yesterday's trading, we paired some of those gains in today's trading. If we throw a Fibonacci retracement study on that rise, we see that today's fall amounted to about 61.8%. It fell a little bit below 50%, so that was our test for today's support. Also, we cracked a downward sloping line of support yesterday around the 1.6750 area, and today that level of resistance now has turned to support in today's trading. And so we tested that twice. Once prior to the New York Open, and again around noon New York time, and we've sort of set up a new sideways range if we throw another trend line around our high from today, which was a test of yesterday's high. So this high here came in the wake of the UK consumer inflation data that we had just mentioned. But then as stocks fell overnight in Europe and were weaker to start in US trading, we had this bout of greenback strength. Here we take a look at the Australian dollar US dollar pair, and we see a rather strong slide in favor of the greenback, though if we take a look, we see that we do have 2 higher highs as well as 2 higher lows, so this pair still favors the Australian dollar from a technical standpoint. However, we haven't been able to retrace today's fall, and we have to see what happens in overnight trading and in tomorrow's trading before we can say that with more certainty. The Reserve Bank of Australia mentioned in its meeting minutes that business and consumer confidence could prove fragile, and that economic activity at home and abroad might slow more than expected as the effects of stimulus measures faded, and as well that its higher exchange rate could constrain output and inflation. So those were some dovish sort of statements that leaves when they will next raise interest rates, in their words, an open question. So that pressured the Aussie in today's trading, and also sort of set a tone of risk aversion in the overnight Asian session. In a quick look at the US dollar Japanese yen pair, we see that we broke a level of support yesterday's trading, but that following a retest of yesterday's low around 88.75, we now are retesting that level of support as resistance. The greenback also managed some strong gains against the Swiss franc, rising from the 1.0050 level all the way up to 1.020. Zooming this pair out, we see that we have a bit of a range now with those 2 price levels that I mentioned as our support and resistance. Tonight we get 2 releases from Australia, the WMI leading index, and a look at quarterly wage prices. Overnight, the Eurozone will post its current account, and the UK will release its Bank of England meeting minutes, along with the CBI industrial trends order. Tomorrow, both Canada and the US post their consumer price indexes, and the US will release data on housing starts and building permits. And that'll do it for today's video recap. For more analysis and videos, please visit our site at fxtimes.com. I want to thank you for watching, and happy trading.